Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello and welcome to another Life Unlimited podcast with your host, Larry Heller. Today, we're talking about tax planning and investing, maximizing savings for work and retirement. All right, Larry, I don't know how long ago it's been since we talked about this, but when you and I first started working together many, many moons ago, you said that you were a recovering CPA, right? You remember that? It was quite a while ago.
Yeah, no, I still talk about that. So that's a pretty good memory because I was going to kind of lead with that anyway. So absolutely. So yeah, was a CPA and I don't practice that anymore, but it really helps when you're looking at the investments and the planning together to really see, well, okay, how can you save money on your investing? And I'm really shocked and surprised when new prospective clients come in and nobody's really talked about a lot of these strategies that should be implemented, because it's really not what you earn. It's what you keep after taxes. So why not incorporate these strategies? It's not going to hurt the investing. So there's so many different ones to look at. Not everyone is going to, not everyone is going to be for everybody, but there's a lot we can talk about while you're working. And then when you retire, there's even different strategies to put in place.
Well, and I don't think people really understand that a lot of these strategies, the earlier that you employ them or deploy them in your specific, longevity of your financial planning and your financial life, can make humongous differences on the amount of money that you have in retirement, and more importantly, even what you're bringing home. So, okay, so we're going to start this up by talking about some of the things that you need to do while you're working.
Yep. Hopefully my coughing fit is past us, but yeah. So whether you're working or you're not working, one of the things that we talk about is capital gains. So capital gains is really the selling of a investment for a profit, and you have to pay taxes on that. And yes, you don't want to have taxes dictating what your investment strategies are, but you want to look at that and see what the capital gains are, because that can kick you up into a much higher bracket in some of the investments some of the other income that you have, and even the type of investing. So over the last, it's been a while now, ETFs have kind of taken hold because they don't have capital gain distributions like mutual funds have. So I've spoken to people and they've had a down year, and they get to the end of the year and they find out they owe money because they had capital gain taxes, and they go to the account. How can that be? And that's because they're in a mutual fund that mutual fund had people buying and selling. So they had a share in those capital gains and pay taxes on those capital gains. So, looking at the type of investment to see if you can minimize what your capital gains are going to be over the years. And this is every single year. It's not just 1 year. So that's why ETFs are much more tax efficient. And if you can use the same exact fund that maybe you were going to, but an ETF, it could be so much better for you. So that's really the first thing to kind of look at is, how you are going about investing and what do you select. The other thing is that I'm
sorry. Hold on. I'm sorry. Did we do an episode on tax loss harvesting? Didn't you spend almost a whole episode on that previously?
We're up to over 150 episodes. So I think right. We did, but so maybe we'll check and put it in the notes there. But I think we did a whole episode on tax loss harvesting, because it's so important. And if you don't do it, you lose it. So Yeah. So right now, if you're listening to this episode in April already, 2024, we the last year and the last year and a half, we've had an up market, but 2022 was a down market. And even if you're in an up market, doesn't mean that your specific investment is up for that year. So at the end of the year, we look at all our clients, and of course, we want all their investments to be up. But sometimes, because the market is down, that maybe one of your investments is down, and if you do nothing, then you can't take advantage of this down tax loss harvesting. So one of the ways just to do this, and we'll go through quickly because you can go listen to my full episode on it, is you sell. You book that loss, you buy a almost identical fund or a similar fund, and then 30 days later, you go out of that fund and back into that fund to avoid the wash sale. And what you've now done, if you've now in the same places you would have been, but you've booked that loss for tax purposes. So if you can do this, even if you don't have gains to offset, you can accumulate these losses. So when you do have gains, because you can carry forward these gains, you can offset your taxes. And a lot of times that'll save you thousands of dollars on your tax returns by doing this. So make sure your advisor is looking at any tax loss harvesting on a year-by-year basis.
Now, to Roth or not to Roth is the question here, because you've got a couple of main points that you want to talk about traditional 401ks, Roth 401ks, backdoor Roths. So let's break that down.
Yep, we'll break that down. And I think I also did an episode on this too. So, but knowing what tax bracket you're in and knowing what tax bracket you're going to be in later on can be the difference again of a significant amount of taxes that you may not pay. So should you be in a traditional IRA 401k or a Roth IRA or 401k? And the rule of thumb is if you're in a low bracket now and you're in a high bracket going to be later on, you want to do a Roth. If you're in a high bracket now and you think you might be in a low bracket later on, you do a traditional. And nothing to say that you can't do both of those. So knowing what your brackets or you think are going to be and deciding what they are, because we'll talk a little bit about them in a little while in retirement, with required minimum distributions being pushed further out, knowing what a lot of people are going to be in super high tax brackets later on. So maybe now it's okay to do a Roth, even if you're paying a little bit more taxes and saving a lot of money later on that. So actually projecting that and planning that out is super important. And people just don't think, they go, oh, I'll do this, or they just say Roth and they just check a box on their 401k. They don't ask anybody for help on which ones they should do. So especially if you're younger in a lower tax bracket, Roths could be the way to go.
All right.
And then there are these backdoor Roths that you mentioned, and
yeah.
It's still totally allowed. The government has talked about closing some of these backdoor Roths, and there are certain restrictions and there are certain rules you need to follow. And again, you can go back to one of my all the episodes on this. But being able to convert into a backdoor Roth, where you're taking a non-deductible IRA and you're converting it into a Roth, and there's mega Roth conversions, mega backdoor Roth conversions as well, you're able to now, again, have an investment that is going to grow for you tax-free, and you're not going to have to pay taxes when you pull the money out. So again, it's not, a lot of people are like, oh, what sector should I be in? Should I be in the stock market? Should I be in US market? Yeah, you want to talk about that later on, but before, you want to kind of look at really the foundations and see which investments you want to be and how to take advantage of some of these structures to save you a lot of money.
Speaking of saving money and different sorts of tax things, right? So we always talk about stocks, bonds, and mutual funds, right? So the one thing that we haven't really talked about is bonds. So let's talk about it.
Right. So again, knowing what tax bracket you're in is super critical for a lot of different reasons. And one of it is, should I invest in taxable bonds or CDs or treasury bonds or corporate bonds, or should I invest in municipal bonds? And how do you know what difference there is? So you need to know what tax bracket you are and what kind of returns you're going to assume in this different investment. So if you're in a super high tax bracket, tax-free bonds may be a much better way for you to go. If you're in a low tax bracket, you may be better off in corporate taxes. So again, we see people coming in and they have these bond portfolios and these bond mutual funds or ETFs. And then we do the calculations and we show them, hey, you could be putting much more money in your pocket by using tax-free bonds. So again, knowing which the right proper investment is for you in your tax bracket. And a little bit about just the tax bracket, and it's really not really the investing side, but knowing what your deductions are and knowing year by year, you may be in one high bracket in one year and a lower bracket in another year. There's some different planning strategies. One could be bunching deductions. And maybe those years that you're in a low tax bracket, or maybe for some reason you didn't work that year, maybe now you want to do some Roth conversions, which we'll talk about, which is mostly done usually later in life, but you may be beneficial by doing it younger if you have some of these years when you have no income. We've actually seen people do Roth conversions that doesn't cost them anything because they didn't have any income. So whatever income they did on their conversions, they didn't pay any taxes on it. So they moved it from a eventually taxable withdrawal to a tax-free withdrawal. So a lot of different things that you can do and you can look at while you're working and while you're going on to make sure that you minimize where you can as much as taxes now, but also set yourself up for 10, 20, 30 years down the road to offset a lot of those. A lot of times we'll have clients that come to us older on and they've got millions of dollars in their qualified account. And now they have to take out these required minimum distributions and they're paying huge amounts of taxes. Yeah. So it's not just something to be doing while you're working, but it's something to think about later on.
Well, in a perfect world, right, people would be, employing you early and getting advice, in their 20s, 30s, 40s with you. But you and I both know, brother, that a lot of people are showing up, really 5 years from retirement and they're like, I don't know what to do. So let's switch gears and talk about how you can go ahead and maximize, these tax efficient strategies when you're getting closer to retirement.
Yeah. So there's a big change when you're going from working to not non-working. And some of the strategies are, first of all, which accounts to draw down and when. So looking at the cash flow. I mean, we do as part of our planning each year in retirement, but a whole cash flow analysis from where you are all the way through the rest of your life. And that when we do that and we use certain projections, obviously rates of returns, but we can look and see what the tax bracket is going to be. So, and now once we look and we see this tax bracket, things start to open up and start to look at some of the planning. So for example, you may be, I'm going to pick 65 and you retire and you are in the top tax bracket. And now you retire and you have no more income coming in. And let's say you've elected to wait into 70 for your Social Security. You may wait into normal retirement, may wait to 70. And all of a sudden, you may be in what we call a donut hole where you have very little income from 66 to right now it's 73. But for anyone born in 1960 and later, the required minimum distribution is not until you're 75. So you may have 10 years where you're in a relatively low bracket. And then all of a sudden, if you wait and you don't pull out anything out of your retirement account for 10 years, now you hit 75 and you got to pull out large amounts plus your Social Security. All of a sudden, you're in the top tax bracket. Yeah. So it may be beneficial to pay a little bit each year and take money out of your IRA accounts or your 401k, your qualified accounts, rather than spending down your non-qualified, your cash accounts, and waiting until later on, because that's what a lot of people have always been taught. Just keep deferring, deferring, and deferring. And yeah, that may make sense, but there comes a point where it may not make sense. So you have those years where you can do those when you're looking at the year by year and seeing, okay, which accounts do we want to take the money out of? And knowing what your tax bracket is and knowing what your cash flow is going to be. Are you going to have a windfall somewhere else? But planning for that is so critical when it comes to withdrawing your money.
Well, the second part of this, outside of withdrawals, is if you weren't able to do a Roth conversion early in life, now might be the time to do that. So let's break that down too, please.
Yeah, so we talked a little bit about what I call the donut hole, the lower income side of this. So now you have these years where maybe you want to don't need the income, so you have some options to take money out of your retirement accounts and convert them into Roth conversions. Now, there's two reasons you might want to do. You may want to do it for yourself because it may be beneficial, but it also is going to help the next generation, because when you pass away and your spouse pass away, that money goes to a non-spouse, a child. They're forced to take money out over 10 years. And a lot of times they're already earning their high income at that point. So now they have to take this money out of a qualified account over that 10-year time frame. But it wouldn't be great if they could take it out and not pay taxes. So we actually have some clients that are doing this really as a favor for their kids. So they're doing some Roth conversions. They may be paying 12, 17% taxes, but now they're putting it into a Roth account. They still control that account in case they need it. But what they now doing is when their kids or maybe even their grandkids inherit this money, they will have to take it out over 10 years, but they won't have to pay any taxes on that. And that could be super beneficial and save them so much money. If you have an IRA and you pass away, and let's say it's $500,000, and you've now got 10 years to take that out, it's an extra $50,000 a year. Well, if you're in the top tax bracket, you could be paying $20,000 a year on that $50,000. Whereby if you did this Roth conversion earlier on, your kids will be able to get the full amount of that $50,000. So it's so important. And we spend so much time on looking at your tax brackets year by year and not just worrying about your investments, but looking at the taxes and looking at how you can have more money in your pocket, either while you're working, while you're retired, or how you can provide more money to your kids and your grandkids by minimizing the income taxes to them.
I know we've done episodes on Social Security, but you just kind of sprinkled some stuff in there, Larry, that I'd like to address before we wrap up today's show. About the election of Social Security during retirement, when because there are so many decisions. I don't remember what it was. I was on a podcast with somebody else. Heck, it could have been you, that there's like 450 different variations or something like that on questions that you need to know in order to elect Social Security that will be most beneficial to you. That's something that you have a lot of experience in. Would you mind just giving us a 30,000-foot view on the philosophy there before we wrap up the show?
Sure. I mean, they've pulled back some of the options that you can do in the previous, tax changes, but there's still, knowing when to take your Social Security is critical, and it's different for everybody. I mean, if you wait to age 70 while you're working, your benefit's going to go up by 8%. So that may be something you want to take advantage of, but it depends. Does your spouse have their full Social Security? Because when you pass away, your spouse is going to lose their Social Security, only get one Social Security. So maybe you want to bump that up. Or do you know what your health situation is? So you want to take your Social Security earlier. And if both spouses are working, maybe you don't want to wait to 70. Maybe you'll take it at normal retirement age. And what I talked about before. Maybe you don't really need the Social Security to live on. So you say, you know what, I'll push that back a little bit, which now allows me to do bigger Roth conversions. So it's not just one strategy. There's a lot of different strategies that come into play, but don't just look at the Social Security side, look at the tax standpoint, and you got to combine all these strategies to see what works right for you. Of course, a lot of it is, what do you need? What are your income needs? So it's a big puzzle, and looking through all the, the pieces to find out which is the best solution for you is something that we do, and we do very detailed, and we're doing it for all of our clients.
Well, here's the $1 million question, Larry. Isn't your tax professional doing all of this for you already, dude? I mean, isn't that their job?
You would think so. Now, again, I'm a former CPA, so I remember that, but believe it or not, most tax professionals are not doing this kind of proactive type of planning. Yes, if you ask them a question, and for us, we'll do this analysis and we'll send it to their account to get their blessing on this before finalizing and executing, make sure there was nothing that was missed. But most accountants are really just doing your tax returns, and they're not looking at your investment strategy, your cash flow, your Social Security, your deductions. They're basically doing it after the fact. Now, some may have conversations with you and do some high-level planning earlier on, but they're not doing it at this particular detail. So I wish that all accountants really were proactively involved in doing some of these. But again, if you can have your financial advisor, your wealth manager, coordinate that with your other professionals, such as your accountants, and you're getting a team approach, and now you're finding ways of saving money, but also making sure that it's blessed by the accountant. So again, we do all this planning. We do a lot of this planning at year end, get the accountants involved to make sure that we're both coming up with the best strategy and the best way of putting more money in your pocket.
All right, Larry, if anybody wants to know more about you and get in touch with your firm to find out how they can go ahead and, maximize their savings for work and retirement, where should they go?
Sure. Yeah. You can go to our website, hellowealthmanagement.com, and you can click on right there to schedule an appointment with myself or one of my other planners, or feel free to give us a call at 631-248-3600.
There are a lot of things, a lot of considerations you should have while you're working and while you're preparing, and then, of course, while you're in retirement, that really can have massive tax implications for you and your family. Make sure that you go to hellerwealthmanagement.com, take a look, have a conversation, maybe just get a second opinion about what you could be currently doing. And with the experience that Larry and his team have, you can truly maybe just have an alternate perspective that could make your whole retirement world even better. So for Larry, this is Matt Halloran, and we'll see you on the other side of the mic very soon.